Welcome to Focus on Fuels, brought to you by StoneX. Your hosts are Trevor McClanahan, Risk Manager, and Alex Hodes, Director of Market Strategy from the StoneX Energy Desk. Alex and Trevor help fleet managers, fuel buyers, and energy procurement specialists gain control of fuel costs, boost margins, and keep their businesses competitive. Join them for another deep dive into the volatile energy markets.
Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results.
Welcome back, everybody, to Focus on Fuels. I'm your host, Alex Hodes.
And I'm Trevor McClanahan. We are back on the roller coaster this week, Alex.
Yep, today was actually kind of calm. I think diesel was only up 5 cents.
Yeah,
the last time I checked.
Yeah, we've only had like 15-cent swings today, other than the 30 that we've seen in the last couple days. But yeah, it's like you said, it's kind of becoming the norm at this point. We had some news today, so today's April 9th for the audience. We're talking at 12:32 because that actually matters in today's age. Headlines are so rapid, and this market's so fluid right now with all of the updates that we're getting. As far as Iran war goes, that things change on a dime. We actually seen that today on heating oil, where I started the day up, and it was got up to like 405, and then it drifted down to, and the day over day change on that was now around 15 to 20 cents, and it drifted down into the back under $4. On news that Netanyahu is going to basically be open to a ceasefire with Lebanon, which is basically kind of what truly matters for Iran at this point, and the ceasefire with the U.S. and Iran, because Iran's ultimately said, if Israel stops attacks on Lebanon, then we will agree to a ceasefire. That's at least what the announcements are showing. So, that's moving the market right now down a little bit more. There's more optimism the war could actually end with that news. But it still seems very, very fragile. Things are, it's definitely not over yet. That's one thing that we've been kind of stressing to clients so far.
I think so. Yesterday's big sell-off, which I didn't know it till I came in this morning and read some articles that they said that yesterday was the biggest sell-off since April of 2020, which is kind of surprising because I honestly thought maybe one of those days in 2022 would have been kind of the biggest down day. But anyways, I mean, that was on the heels of kind of the agreement between the U.S. and Iran that they would pause, have a temporary ceasefire. However, that ceasefire is supposed to be it's supposed to be dependent on whether the strait is actually fully open. Like that was what President Trump stated. And reports are that the strait remains closed. So there's kind of some mixed messaging, just to say the least, honestly. And then there were also reports that Iran was really still adhering to that 10-point plan, which included military withdrawal from the U.S., toll system by Iran. And some of those ones were kind of like hard lines that the U.S. and other Gulf states had really stated that they wouldn't kind of agree to. So, but then there were reports that was fake. So it's kind of hard to believe. But one thing to actually, when you look at the flows, we still have not seen the ships kind of move across, and that's what matters most right now. However, it does appear like there's somewhat of progress being made with regards to talks, more so than the past several weeks. But really, the biggest thing is that as long as the strait remains closed, this is really the only thing that's going to drive the market. It just dwarfs every other aspect of the market. There are some caps to how high prices can go due to demand destruction. There are reports of some demand destruction in Asia, whether that be with regards to crude oil runs reducing in Asia, jet fuel demand being capped because Southeast Asian airlines are reducing flights. So we're seeing some demand destruction, but whether that comes in full force, it seems like we're still like weeks away from that, or, before you start to see that occurring in other places than just kind of some of these one-off areas where the demand is demand destruction's mostly happening in Asia. Maybe we'll start to see it more so in Europe. And that should be kind of the next one, and then eventually spill over to the U.S. if prices get that high. But it all infringes on, or is dependent on, whether this ceasefire actually works and if ships actually get to flow.
Yeah, it's kind of interesting too on what how the negotiations are happening. There's a lot of uncertainty on just everything that's happening here and who's actually involved in these negotiations. From the U.S. point of view, it's not, I think obviously that Trump's team is involved in that, and on that. But on the Iran side, there's a lot of question marks around that, because if the president of Iran, or whoever the diplomat is that is having these negotiations, there's not a lot of certainty whether or not they're in lockstep with whatever the new Ayatollah is if they're in agreement with one another. And remember that Ayatollah has the ultimate control over the IRGC. So, that's another thing that I just, I'm kind of sitting on the sidelines looking at this from the outside, looking in and saying, is this even possible?
There's definitely going to be some hesitance, even if a ceasefire is agreed to, especially when, if the IRGC is saying one thing and then the president is saying another thing. And ultimately it'll come down to if those ships are going through and then they say, hey, you can pass or you cannot pass. That's kind of where it's going to be, where we're going to see whether it's actually working or not. Either way, though, it's going to still be kind of a slower trickle through there, even if it was fully opened right now. I would imagine there would still be some hesitance by a lot of ship owners, and I'd imagine that insurance rates would still stay very high.
Yeah. And the damage is done allude to these GCC nations as far as the wells themselves. Kuwait, for example, shut in basically all of its production, and you can't just snap your fingers and bring that back. It won't take, I think they were kind of when they did shut these wells, and they had expectations obviously to reemerge these at some point. So I think they will bring them back faster than what what a normal shut in would look like. But there's probably still a little bit of a lag time there, a month or two, where you're not going to see that production go back to where it was prior to the war. And same thing with Iraq and Bahrain as well. So all three of those, we'll continue to monitor, but I think it's too hard for us to even make a prediction on what's going to necessarily happen with the war next. It's so all over the place. It's really hard to have any kind of true expectations of what's come to come. But with that being said, we can still, realize that even if this thing does, all of a sudden resolve itself, there's going to be some lingering effects to this the situation. So, we're not probably going back to $70 a barrel by any means, like snap of a finger, but it will be, things resolve and progress nicely. It should sell off at to some sort of easier rate than what we've seen on Tuesday.
Yeah, and I think so. With that being said, what are kind of, I guess, the ways to strategize around the current environment? I think that's a challenging question right now, but I think kind of like depending on where you see the market, where the risks are, it's almost like you see substantial risk to both sides. But what's kind of been more attractive recently due to kind of all this volatility?
Yeah, so if you're having a lot of upside, if you have it both ways, really, we've done a lot of min-max structures where, you're buying a call spread and selling a put or vice versa. And basically, the concept of that is this volatility is so high, we want to ultimately sell vol, which you're selling premium, because when you're doing those min-max structures, you're ultimately buying one call or buying one option and selling two. And the two options you're selling or financing the purchase one. So we're able to get those at some really nice levels where you can give yourself tons of upside protection while giving yourself some slack to basically miss if you were to get it wrong. And again, if you have downside risk that you need to cover, then you can do the same concept. I like those in the near term big time, just because, it, like I said, this market's moving so fast that it gives you some slack to basically miss. But these are things that we kind of strategize for each client is a little different on exactly what they're looking to achieve. If you don't like the idea of kind of being capped on how much you can actually cover to the downside or upside wherever your goals are, then we modify our strategy accordingly. So the big thing is for me, I really like, for any end user, covering some summer gallons more so than anything else. Going beyond that, obviously the curve is extremely advantageous, considering how backwardated it is, all the way through. But I think the immediate risk right now sits in the summertime right now. And, I think doing the structure like we just talked about, you're taking advantage of backwardation. There's a ton of it. And then you're also, able to give yourself some flexibility, so you're not going to get completely your face ripped off, right? If the market decides to go the other direction, wherever your positions lie.
Yeah, and I think just to kind of explain a few things. So I know we've talked about it a little bit, but the backwardation in the market. So when Trevor or myself say backwardation, meaning the front months, so the nearby months, are a lot more elevated than the later months. And that does explain a lot of kind of the characteristics of some of the market participants. On the other side of the story, if you're a producer, so if you're a crude oil producer, something like that, so a lot of people are like, okay, well, the price is at, $100 per barrel. Why don't producers just hedge this? And then, then they're locked in for $100 per barrel and they're going to make money forever. It's funny to see that, because then you see what the actual curve is, and November and December are at $70. So if people are wanting to lock in their production, it's a lot of those people are hesitant to do that right now, because those prices are still not really in that $100 barrel mark. So really understanding the structure of the market, we try and talk about that a little bit more, because it tells a lot about kind of the behavior of the market participants. So whether you're a consumer, whether you're sitting on inventory, or if you're a producer, it's kind of, you have to take that into account above a lot of things. So when we talk about kind of how flat price is going, when where the market is going, everybody's got to have an opinion there, but a lot of the other stuff kind of matters more. So
yeah, and that's a good point. And I think that a lot, and this is a misconception constantly, is what we hear is that the forward curve is a representation of what the market thinks it's going to happen next. We just want to debunk that whole concept, because it is not. It is just the structure of the market is based off supply and demand dynamics at the time, and it doesn't cost of insurance. I won't get into the details of what really bakes into that, but again, this is not that has nothing to do with what the market is kind of forecasting in the future of what the price is going to do next. It's simply structured for all participants to basically, it's again supply and demand dynamics of all those different participants that you just kind of went through. So anytime that guys are looking to lock in these higher ranges that we're in right now, they're significantly cheaper on the further out that you go. if you wanted to lock in fuel for, the end of the summer, you're able to get, 70, 80 cent discounts, by doing that. So, in the fall and in the same case there. So, that's advantageous. We seen that at the very beginning of this last month. I had guys that were locking in just simply 2 months ahead, and they were getting 70-cent discounts by doing that.
Yeah.
Funny because it kind of just rolls into itself. If things remain the same, then you're just getting that discount, kind of naturally. But it's not to say that things can't go down.
Yeah. Yeah. And I think it's funny, just to like kind of make sure that it doesn't sound like we're always saying, this looks like a good time to buy, because we do say that quite a bit. But I think the way you explained it there makes total sense, is that you're getting a lot of a discount in the latter months. So there's value out there, even if, prices are extremely elevated. You're getting it at a much of a discount in some of the later months. And especially, like you said, if this persists through the summer and fall longer than what's being priced in, then even if prices fall down in the front, you could still be in the money on those. So, and honestly, it's just about helping people sleep at night. So
yeah, definitely.
It's more of a budget thing. We can always try and guess the low point, but
yeah, that's the biggest aspect of this, right? If you're going to go out and go buy a forward contract, right, lock your fuel cost in for the summer, and if prices do fall, then it should not affect your business to where it's going to make or break your year. It should be the opposite, actually. So where you can know your costs going into it, now you can budget around it and know your margins, by the end of your project, whatever you're doing. So that's really what the whole concept of forward contracting is. It's not this guessing game that we're trying to guess the very low of the market. It's nice when we do. But more than anything, it's a budgetary tool. So, we stress that to all our clients. And one other thing that I just wanted to plug out there is the fact that we have fuel distributors all over the country that offer forward contracts all the way down to customers that have, 5,000 gallon on-site tanks. So don't feel like, even if you're listening to this podcast, that you need to be some massive end user that is using either, more than 42,000 gallons a month or whatever, it may be. This applies to anybody that's out there using diesel fuel, gasoline, that is using it for, projects of any kind, commercial usage typically. Retail guys, we don't typically ever ask to do any kind of locking in of prices. Just doesn't really make sense in your guys' case. But again, anybody that's burning the fuel themselves and, has that cost on their balance sheet, this is a tremendous way to budget your fuel out. So if you're a person that uses only, 5,000 gallons a month, even, that's not a problem. We have a customer out there, the fuel distributor out there, that can offer you a forward contract if you are in the U.S. They can lock in your fuel cost for any amount of volume that you're looking for. So we can hook you guys up and find you somebody to, lock that in with if you reach out to us. And if you are a larger client that is using, anything, I would say probably more than 300,000 or 400,000 gallons a year, you could set up an account with us directly, and we can get you taken care of, and manage the risk internally. And then you also have somebody to talk to about this stuff when need be. So, yeah, I just wanted to kind of stress the fact that it's not just for the massive consumers. This can be for, anybody out there for the most part.
yeah. And I think that's what we try and do, is try and send a message out there to everybody who's interested in the oil markets, what our thoughts are. And yeah, no matter what your exposure is, we're trying to kind of provide you with some insight of how you can kind of manage your business by what's going on in the markets.
Yeah, it kind of levels the playing field for you. It doesn't make it to where, only the massive players are able to participate in this. It's we're trying to break this down to where it's good for everybody, and it's very economical too. We're not, blowing the price up a bunch to where it doesn't make sense for you guys to do so. So just wanted to plug that in.
And I think, so today we just kind of wanted to provide you all an update of kind of what the market was doing. But again, just also telling a little bit about what we do. One of our other big selling points or just what we pride ourselves on is education. So we put on hedge schools. So one of our colleagues, Nathan Cowan, he puts on a lot of our hedge schools. And we have one upcoming. It's in Tampa area in June 9th through the 10th. So it's essentially a 2-day class to learn all about hedging. And it's in Tampa in summer. So it's going to be a nice time there. Looking forward to it. So if anybody would like to know a little bit more about that, we'll have a link in the show notes and you can sign up there if you're interested. I think that'll be all for today, but we'll try and keep you guys all updated as much as possible.
I'll add one thing here, because this is how fast this is moving. But we just got a headline, and this is from CNN, that there'll be no ceasefire in Lebanon.
Okay.
So
Okay.
I don't know. Maybe we go back up from there. It's hard saying, but who knows? In 20 minutes, we might get another headline that says that was a false report of some sort. So anyways, well, we'll get back on the roller coaster. We'll white knuckle through this and see if we can, make sure we're keeping everybody safe on their prices. But anybody that's interested in anything else from us that we kind of talked about today, please reach out. We have emails in the show notes, I believe.
Yep. Thanks,
guys.
Bye.
You've been listening to the Focus on Fuels podcast with Trevor McClanahan and Alex Hodes, brought to you by StoneX, NASDAQ ticker SNEX, a global Fortune 100 financial services company with a century of commodities risk management experience. Subscribe to Focus on Fuels on your preferred podcasting platform. For insights on managing fuel and energy price volatility, and to sign up for the free StoneX Morning Energy Brief newsletter, email focusonfuels@stonex.com or visit www.stonex.com. Please feel free to rate, review, and share this episode with colleagues. Until next time.